Now let's get to the market action with Charlie Bobrinskoy of Ariel Investments and Ryan Detrick of Carson Group. Welcome, guys. Charlie, as the Fed also points out, you say the S&P is moderately expensive here, but we're at the end of a week where I'd argue the AI trade, the AR argument held up with Microsoft Ignite arguing for more demand from software, NVIDIA earnings coming in at or a little above expectations. Then we got the consumer taking over the narrative over the next few days with Black Friday and Cyber Monday. Couldn't sunny days justify these valuations?
Sure, the sun is shining, but the question is how brightly, and is that overly reflected in certain stocks? I mean, you know what I'm going to say. The names in the S&P 500, the Magnificent Seven, I think at this point are pretty clearly overvalued, although there's obviously lots of positives going on. But the good news is that the rest of the market, and small cap value in particular, is very reasonably priced at 13 to 14 times earnings. So we do have a bifurcated market, and we're seeing some rotation. This week, we had the 2,500 value index and the 2,000 value index outperform the S&P. So we're getting some things to come back. But I do at this point think it's hard to justify the valuations of some of these AI names.
Okay. Well, Ryan, you're neutral technology as well. But once we get past the mega caps, I can't help but watch. I've been watching some significant moves. AppLovin is up about 3x in 3 months. Bill up 80%, Twilio 75%, Atlassian 65%, C3 50%. Some of those smaller software names that have been getting beat up over time seem to have caught a bit of a bid as part of this broadening as well. All tech's not the same.
No, that's right. And not all days are the same. It's Friday. So happy Friday, everybody. You think about it. I agree. I agree with Charlie there. I mean, I've gone for a while saying we're neutral tech because those big names are a little on the pricey side. Yes, that's where the earnings growth is coming from. But just look at today. It's a microcosm for what's been happening. Financials, I mean, banks like hit all-time highs today. Industrials led, small caps, mid caps, right? That theme of broadening out continues. Is it because of the election? I'm not so sure, right? I know the election was a reason lately, but right up to the election, year to date, financials was like the second strongest group. So this is nothing really new. This is accelerating those trends that we've been seeing. And I'll tell you this, though, you look at tech, yes, I mean, there are some clear opportunities out there, John, like you said, on the smaller end, the smaller cap. And those are some of the areas we like. Again, we like small caps relative to large. So that's nothing really new to me there.
All right. Charlie, we had earlier today on CNBC, we had strategists from JP Morgan and Goldman Sachs who are both pounding the table on mid-cap stocks, which we don't really talk about very much at CNBC, and maybe we should. So I want to get your thoughts on that area of the market, too, especially as we do continue to see this rotation into, up until more recently, unloved areas. Like we talked about Russell 2000 and small caps just a moment ago, but also equal weighted S&P, the fact that you have industrials and financials and some of these cyclical sectors continuing to outperform.
Yeah, there's a lot of that truth in mid caps. Everything I said about small cap would probably be true of the mid cap space, just not quite so much. So the Russell mid cap value index is a little more expensive than the small cap index. But what is a positive for mid caps is there are a lot of great M&A target names in that space, particularly banks. There's some regional banks that are in the mid cap space that in a new regulatory environment and in a Trump administration probably trade better. And frankly, the yield curve is very good for mid cap banks. Mid-cap banks tend to borrow short, lend long, and so when we get a positively sloped yield curve, those mid-cap banks do very well. So I would support the idea that mid-cap is attractive, but small-cap value is really attractive.
And Ryan, I mean, seasonally strong time of the year. We've talked about it with you before. Post-presidential election, going into the holiday season here. How much of this is just what you would textbook see at this time of the year, given the events we've had in recent weeks, and how much of this is really truly unleashing of animal spirits and FOMO and TINA and exceptionalism and all the other terms I'm seeing bandied about?
All those things. I mean, listen, I think it's just normal, right? After elections, we saw the VIX spike, we saw the put buying, we saw the hedging, the uncertainty election out of the way, and you get the upward bias. Now, here's what's interesting. We know November's been higher 10 of the last 12 years, and here we are, another November really strong. Around Thanksgiving, so next week, that's a really strong week around holidays. Not really a big surprise. But when you're up a lot for the year, like 17.5% for the year going into November, like we were obviously right now, The last 2 months, okay, have been higher 14 out of 14 times of almost 6% on average, okay? Last I checked, we're not up 6% this month yet. We still think here, Morgan, that there is more juice kind of to this. And why is it? I talk to a lot of people. A lot of people manage a lot of money. Come on your network, manage a lot of money. The honest truth, a lot of people have still missed this rally. A lot of people have been underweight, stocks relative to the bonds, all that stuff. You can call it a chase. You can call it what you want. The reality, a lot of people were caught off sides, and they're still coming into this market, even at all-time highs.